The sovereign debt crisis is aggravating the already precarious position of many banks. Their business models are evolving in response to the last crisis, but not fast enough. Banks continue to feel the impact of reputational damage, and their cost bases are no longer sustainable despite improvements to restore profitability. Joining me now in studio is Emilio Pera, Lead Financial Services Director at Ernst Young. Thank you so much, Emilio, for joining us. Great to have you on the program. We're talking about banks starting to evolve to try and cope with a very different scenario on the ground, and also a lot of risk aversion that we've been seeing. And just today we heard that Societe Generale says that it's going to cut hundreds of jobs to try and deal with the weakening in demand and, of course, the sovereign debt crisis that has hit the Eurozone. How much more evolving needs to be done to cope with all this drama?
Yes. I suppose in some it's a reaction to the market and the changing dynamics in the market, but also the changes in the regulatory framework. If you look at Basel III, some of the principles still need to be refined at a local country level. So definitely significant challenges to try and balance the opportunities that is available in the market, especially in emerging markets on the one hand, but also in developed markets, some of the challenges around the market that's just not growing, as a point of fact, the sovereign crisis.
And of course, what we do know is that there has been a move towards a more boring, if we could call it that, banking sector, something that is far more conservative in a sense, similar to the model that we see here in South Africa. Is that actually doable going forward? And what is it going to do to profits down the line? We've seen the separation between investment banking and, of course, the retail banking sector.
Yes, and as part of the regulatory framework, it is specifically looking at splitting the higher risk areas within the banking operation, or it has to raise additional capital in order to fund that. So I suppose it's a balance between the profitable business, but then the capital that will be required to sustain that.
Thousands and thousands of jobs are being lost within the banking sector to try and cope with the changing environment. Tell us about the cost bases right now, the fact that they haven't actually been very sustainable. Are we moving to a more sustainable environment and a far more efficient environment? One always looks to that cost to income ratio. Absolutely. With banks to tell really where profitability would be going.
And that's been a key focus for both the international banks and for our local banks, where it is to drive the costs down on the one hand, partly because the top line isn't growing, significant impairments coming through on the one hand, but also credit extension has remained limited. So it's not just to reduce staff, but look at innovative ways in order to reach clients, and that would be through IT, mobile banking as an example, which would obviously then reduce the need for a branch network as an example, and that results in a reduction.
So technological advances there, perhaps counteracting a consumer that has less appetite for credit. Hey, all right, competition in the sector. You say that it's going to intensify globally.
Yes.
Tell us how it's going to look right now, and you say from sources, unexpected sources.
On the one hand, it is, if you look at Walmart as an example, which has a banking operation as part of its retail operations. So Tesco in the UK. So your traditional banks are now having to cope with non-traditional competitors in the market. And the access, if you consider a retailer like a grocery store, already a significant branch network in effect that they could trade through. So those are the non-traditional competitors. But also looking at emerging markets, and for our South African banks, where the opportunity is definitely in Africa, but it's also, because of the growth potential in emerging markets, a key focus for a number of developed markets banks as well.
Oh, you're talking of Africa, and we know one of the biggest hindrances right now for a lot of the banks to increase their footprint on the African continent is the cost of infrastructure, the cost of rolling out business. We know Nigeria is offering perhaps a lot of opportunity with regards to possible acquisitions, but it's still a very costly exercise.
Absolutely.
How can it be done in a cost-effective manner?
And I suppose that is through alternative tools, IT infrastructure, mobile. If you look at the mobile penetration in the African continent as an example, as an alternative means in reaching your client base, I suppose innovation is going to be one of the key drivers, because it's also that bottom end of the market that you're trying to reach, and the previously unbanked, especially if you're entering into new markets.
Let's also touch on the global bank scenario relative to South Africa. We're very prudent, we're very conservative. It seems that we are well capitalized here in South Africa. the change in the regulatory framework, you're alluding to Basel III, banks are starting to gear themselves up quite extensively. Is it really going to be a very painful exercise down the line, that the impact is going to be as dire as many have been speculating?
I suppose there is still some uncertainty around some of the national discretion and how that will be applied, and whether it will be rolled out in line with the rest of the world. So I suppose there is that uncertainty, but definitely it is going to be a painful and expensive process to update IT infrastructure, as an example, processes, etc., to align to that. But also, given the mismatch from a liquidity perspective in our market at the moment, is how is that going to be addressed to still retain profitability and growth potential for banks?
Oh, we touched on, well, I mentioned Nigeria with regards to perhaps a very good opportunity going forward, and we have a few interested parties here in South Africa. Do you think that it is a good time to delve into the Nigerian markets and actually acquire a bank as opposed to increase your footprint and grow organically?
If you look at the banking sector in Nigeria, it's a well-developed 24 banks. There has been consolidation in the market. So with that change, I suppose there's on the one hand improved regulation, governance, transparency, which obviously bodes well for our South African banks as they enter that market. But also the change in the market does provide opportunity for new entrants. But it's already quite a developed market. I think penetration, there is still opportunity, but as a greenfield site, probably quite difficult to enter.
Emilio, we know that the fate of the banking sector really very tied in and linked in with economic growth, and especially when we start to see an increase in growth in the resource space across the African continent. How are banks going to start soaking up these opportunities across the board?
If you look at, we did a study in looking at growth in the banking sector from 2006 to date, and it has been a very challenging period for the banking sector. And what we found is that in those markets where, because of resource growth, be it oil and gas or other resources, the banking sector has grown with the market. So it is to identify those markets where you do find opportunity from general economic growth and expand in those.
We've also seen, and you mentioned the retail sector, where we're starting to see a lot of the other companies out of the financial sector starting to embark on financial services offerings. How big is this likely to grow? Of course, African Bank has grown from strength to strength. For example, Capitec is growing quite extensively. We've also seen the likes of JD Group shifting from just having one business to having the retail division and then also their financial services business. But the cost of doing business with them as a consumer is slightly more expensive than traditional banking. Could that be then the competitive edge that traditional banks would offer?
Absolutely, and also the cost of, if they wanted to have a fully fledged banking operation, they would have to apply for a banking license, and obviously there's a significant cost attributed to that. So it is to on the one hand balance the cost of running a bank independently versus the current model where it's through the existing banking model or staying on.
So a bit of speculation now, Emilio, so forgive me. We keep talking about contagion. We're really worried about Italy failing, Greece failing. Italian 10-year treasury yields are above 7%, which is considered a danger zone. If we do see contagion going through or a country defaulting in the Eurozone, do you think that we're going to see a bank in Europe failing? Do you think it will be allowed, or do you think they will be saved as a lot of the banks were saved in the US?
I think through the initial banking crisis and the demise of Lehman, a lot of lessons have been learned. And I suppose it is to apply that in the European market. So I'm not saying that it can't happen, but it is to also understand at what point to let go.
Is that a yes or a no? Clearly, we've learned a lot of lessons from Lehman, so perhaps it's not a wise idea to let another financial institution go. Thank you so much, Emilio. Much appreciated for your time. Emilio Pera, Lead Financial Services Director at Ernst Young.